morning, viewers. Welcome to Mia Markets Experience Academy. As you all know me, my name is Bobby Okeke. And this morning, I'm going to a kind of continue where we stop on the beginners class. This should be the episode 5 of the class. Episode 5 of what? The beginners class. So let's actually dive in direct without me talking too much. Let's go to the business of the day. All right, let's move to my slide. Let me share my slide. I believe the last time we talked about, we looked on the different terminology of the market, different terminology that we have in the market. Okay, so I believe we talked on types of orders, we talked on bid, ask price, spread, and what? And the leverage. But today we're doing something different. Today we are going to go deeper on this terminology. So we'll dive deep and try to make you understand how they work perfectly. All right. Okay, perfect. Types of pending orders. We'll be talking on both types of pending orders. If you remember in our previous episode 4, I talked about types of market execution or types of orders. We talk about what instant market execution. I'll talk about pending orders. And I told you that instant market execution simply means placing an order at the prevailing market price. When you place an order immediately and you're being filled in by your broker, that is an instant market execution. While pending order is a futuristic price, you have in mind that the price of the market will get to before your price or your order will be triggered. So today we'll be talking the types of pending orders we have in the Forex market. So we have the word stop orders. The stop order. And under the stop order, we have the two types of stop orders. But before we dive further to this, to explain the two types of stop orders we have, let's please know what is stop order. Stop order is an order to buy or sell a stock once the price of the stock reaches a specified price, known as a stop price. When the stop price is reached, a stop order becomes what? A market order. A stop order is not guaranteed to execute. Don't forget, it says stop order is an order to buy or sell a stock once the price of the stock reaches a specified price, known as the stop price. When the stop price is reached, a stop order becomes what? A market order. A stop order is not guaranteed to execute. Yes, anything that has to do with pending orders, they are not guaranteed. They are futuristic price, and there's a tendency that price might not get to that particular level. So it is not guaranteed. There's no assurance that price might get to that place or to that particular price in time. So it is not what guaranteed. So that will take us to the types of stop orders. We have what the buy stop, and we have what the sell stop. A buy stop, a buy stop order is an order to buy a security which is entered at a price above the current offering price, and it is triggered when the market price touches or goes through the buy stop price. Traders using a buy stop hopes to gain if momentum gains on a particular stock. If momentum gains on a particular stock. Why sell stop? A sell stop order is an order to sell a security which is what entered at a price below the current offering price, and it is triggered when the market price touches or goes through the sell stop price. Traders using a sell stop hope to gain if the momentum gains on a particular stock. So stop orders like buy stop and sell stops are actually used by fundamental traders. They are actually used by what? Fundamental traders, traders that trade the news. You know that the news of any currency pair that you are trading could be very speculative. You never know if the news comes out. Let's assume that we are anticipating to trade Euro USD, and there is a high impact news that is coming out for the USD around 1:30 p.m. GMT. Yes, because you don't know what the direction of the price might go when this news comes out. Whether if the news comes out, whether the US dollar will be mad or will be strengthened. So it is left for you to use what? A stop order, place a buy and a sell stop order simultaneously, giving them a gap of maybe 20 pips. So that if the market comes and it favors what? The US dollar, that means the Euro USD will do what? We sell. But if the news comes out and it's mad the US dollar, that means what? The Euro US dollar we what? We buy. So you place what? A buy stop and what is the sell stop order to trade this kind of news. Yes. So I think I will go to my chart so that I will make it more lively for you to understand. Exactly. Let me use the chart so that you can get it appropriately. Follow me. Yeah. Yeah, let's use this first for clarity. Okay, let's assume we are using this chart for something easy. All right, so let's assume that we are talking about what our buy stop and sell stop order. Consider these two lines. Okay, so let me clone it. So let's say this is, we're considering this from here to here. This is where the prevailing market price is. You can see. Now let's say from the where the prevailing market price you are seeing from my screen to where my buy stop order is like, let's say 20 pips. And from where the prevailing market price is to where my sell stop is what, 20 pips. And we're anticipating that the price of that the particular news is coming out for USD, high impact news is coming out around 130. But we don't know how to trade this market because we are not sure whether if the excuse me whether if the news comes out, it will actually be in the favor of the USD. That is, as we are trading Euro USD, if it favors USD, that means what, the market will go down. US dollar will be strengthened, the market will go down, it will sell. But if the news comes out around 130 and it doesn't favor the USD, that means what, the market will do what? Go up, we buy. It will buy. So to be on a safer side, what we do is to do what? Place pending orders simultaneously. So that whichever occurrence from the news, whatsoever the probability of the news is, it will either be one. You understand? It might either be what, one occurrence. So it's either it buys or what, or it sells. So placing a buy stop and a sell stop order will just save us the trouble. So if I place a buy stop, I anticipate that if the market goes in the favor of the euro, like if the US dollar news or if the news comes out around 130 and it mar the US dollar, that means this market will trigger me up. And if it's a strong impact news, it will trigger me. It will hit my buy stop and trigger it and continue to go up. When it goes up, I make money. When it goes up, I do what? I make money. But if the market or if the news comes out around 130 and it's not, it came out with what, low impact. Sorry, if it came out with what, a high impact, it favored what, the US dollar, and the US dollar got strength or strengthened, then it will what, trigger my sell stop. And when it trigger my sell stop, it will trigger and sell. If it goes down the more, I make money. That's how it is. I make money through it. So that is what stop orders are, the buy stop and the sell stop. That is a perfect description of what buy stop and sell stop order. I believe it's well understood. I believe it's well understood. Okay, let's go back to our screen. So that's it. So buy stop order is an order to buy a security which is entered at a price above what, the current offering price, and it is what triggered when the market price touches or goes through the what, the buy stop price. Traders using a buy stop hope to what, to gain if momentum gains on a particular stock. If momentum gains on a particular pair, Euro USD, if the news comes out around 130 and it is at the favor of the US dollar, that means the market will dive down. Your sell stop will be triggered. But if the news comes out around 130 and it's not to the favor of the US dollars, that means the euro will get strengthened and it will buy, it will trigger our buy stop. It's as simple as that. No more, no less. So that takes us towards the limit order. It's a continuation of what the pending orders. The limit order. The limit order. A limit order is an order to buy or sell a stock at a specific price or better. A limit order is not guaranteed to execute. And under the limit order, we also have what, the two types of limit order. We have what, the buy limit and what, the sell limit. We have the buy limit and also we have what, the sell limit. Limit order simply means that you are anticipating that price will get to a particular point where you will have a better entry or discount. Let's assume that you are looking to buy at a nice resistant level in the market, but the market price has actually not gotten to that resistant level. So you place your what? Your sell limit ahead of time. Now, if price gets to that level, you will enter earlier before any other person. You will enter earlier and have a what? A perfect entry. That's what the sell limit is all about. So we said that a buy limit order is an order to purchase a security at or below a specific price. Traders using a limit order hope to gain if momentum gains on a particular stock. Why a sell limit? A sell limit order is an order to purchase a security at above a specific what? Price. Traders using a limit order hope to gain if momentum gains on a particular price. I know it's a kind of very confusing, but by the time I explain it using my chart, you will get it better. So let's dive into our chart. Okay. Let me delete this stops. All right, I believe you guys can see my chart. Yeah. Let me zoom it a little bit. So let's assume we have this as our what? Perfect resistance. We have not gotten to this level of support and resistance, but with time we'll get to it. So these are what our perfect resistance. The market rallied and got towards this resistant level. Then now we can see that the market is actually coming here, which is our what? Support level. This is our support level. So limit, buy limit or sell limit simply means what? When you anticipate that the market price, let's assume as this market is currently, or when this market was around here, when the market price was around here, let's denote it with this. Okay, let's just denote it like this. This is currently where the market price is. Just watch this, my green line. That's currently where the market price is. So I can place what a buy limit around this area, 1.10428. Yes, I will place a buy limit around that level in anticipation that when price gets to this point and triggers my buy limit, it will help me to buy what earlier and at a very what discounted price. It will help me to buy what earlier and at a very what discounted price than somebody that will start buying from this place. If you're a trader and you start buying from here, when the market dies down here, you will be in minus. You will be in a serious drawdown. But if the market dies down here and trigger my buy limit, I will be in a better position to make more profit when the market starts going up my direction. I will make more profit than the person that entered this place. Yes, before the market will get here, that probably the person that entered early here will be in minus 50 pips or in minus $50. It depends on the lot size he or she is using to trade. But in anticipation, I will place what my buy limit, knowing that this particular zone I'm seeing here is a strong support zone. That there's a tendency that the market price will get to this support zone or demand zone and do what? Start going up. So I will place my buy limit in anticipation that when the market price get to this demand zone, there's a tendency that it will do what? Start going up for me to make profit earlier and make more profits. So it's actually giving me that room to what? To buy at a very discounted price, at a very cheap price. But you know that these things are not guaranteed. There's a tendency that this price might not get to this point. That just as it is, the market will still continue to go up. So that's how it is for what the sell limit. Just assume that where the market is currently, I can come ahead and do what? Place my sell limit here. Okay, let's assume that this market was around here, just like as it is here. I can come here and place my sell limit. In anticipation, sell limit is above what? The current market price. In anticipation that when the market rallies up here, it will do what? Trigger my sell limit. And I will enter the market perfectly on a discounted price. So know that sell limit is above what? Placing your order above the prevailing market price, while your buy limit is placing it below the prevailing market price. So at a discounted, it gives you what? Room to buy earlier at a discounted what? Price. But there's a tendency that these prices might not get to this particular futuristic price of ours. So it is not what? Guaranteed. I hope this is well understood. So when you place your sell limit, sell limits are always placed above what? The prevailing market price, above a prevailing market, while buy limit are placed what? Below the prevailing market price at a support. Buy limits are always placed at a strong support or demand zone, while sell limit are placed at the resistance zone or supply zone. Just have that at the back of your mind. It's very, very simple. All right, let's go to our chart. Probably we see a diagram that will explain that. All right, this is a perfect diagram that what explains what we are talking about. Diagram of pending orders. So we have what? Our buy stop and what? Our sell stop. Just like this arrow signifies. Just like the arrow signifies. Order placed above price. And price keep what? Going up. This is our price. This is your pending order. Remember what I told you about the news? That let's assume that we are trading Euro USD. And when the news came out around 130, it was against the US dollar. It marred the US dollar. So it wasn't a strong impact news for the US. So the news never went to the favor of the US dollar. So in such scenario, that will strengthen the euro and the market price will do what? Will shoot up. These are what? Pending order. These are what? Our buy stop. So our buy stop will trigger. This is where the prevailing price is. But when the news comes out, the buy stop will trigger as a result of the news and trigger us in, and the market will go up with high momentum, making us to make more profit. But when the market goes in the favor of what? The US dollar, this is where the market price was, and we place our sell limit below it. So and we place our sell stop below it. Immediately the news came out around 1:30 p.m. and it was in the favor of the US dollar. It will do what? Push the price downward. So that means euro will be weak and US dollar will be strengthened. So it will push the market price downward, trigger us in, trigger our sell stop, and still move down for us to do what? To make profit. So I believe that is what well explained with this diagram. Then the buy limit. The buy limit says what? Order placed below price, and price then what? Goes up. This is our price. This is where we placed our buy limit. So we did what? We placed the buy limit at this support zone in anticipation that when price is here, that price will do what? Rally down, trigger us in at a discounted price, so that when the market reverses, we start making money. That means we will enter the market before anybody. That is what the buy limit does. But it is not guaranteed that price might get closer to that level and might just get closer and may not trigger you in. I don't know if it's well understood. The same thing is applicable to what? The sell limit. The sell limit is what you place it above what? The price. This is where the price is. But you place your sell limit above the prevailing market price in anticipation that when the price gets to that resistance or supply zone, it will trigger you in and you will enter the market earlier and at a discounted price. And when the market starts going down, you will do what? You will make what? More money. So I believe with this diagram, it is serve what explanatory. So these are the types of orders that we have in the forex market. These are the types of order we have in the forex market. So let's go further. All right, this is my analysis. We'll get to this level. This is stock analysis for Tesla. I predicted Tesla from here. You can see that this market has been making what higher, higher. It is a weekly time frame, and the market broke the counter trend and retested at our supply zone. Just like as I was saying, this was a strong resistance zone for you. If you entered here and started selling, you would have made a lot of money. And the market went here, but this whole setup has what been invalidated, so it's not today. So let's go further. So what is entry point, stop loss, and take profits? What is entry point, stop loss, and take profits? Just like the name implies, entry point order is one that is used to enter a trade at a what specified price level. Entry point order is one that is used to enter a trade at a what specified price level. While a stop loss order SL is an order that closes out your trading position when your losses on that trade, which is a loss amount, which is what a loss amount you set when you initiate the stop loss order. Then a take profit order is an order specifying the exact rate or number of pips from the current price, point where to close out their current position for a profit. The rate deemed to be the level where the trader wants to take a profit is sometimes referred to as the take profit point. So this entry point is if you have a strategy that you are using to trade already. When you have passed this level, you have a strategy that you use to enter the market. Immediately you enter the market to do what? Either buy or sell. These three parameters must be fixed in place. If you are a professional trader and a conservative trader, these three parameters are so very important in the market. They are very important in the market you will enter. You have to place your stop loss. At least before you enter any market position, you would have stomached in your mind that this is the amount of money that I am comfortably losing, that I will be comfortable to lose. Let's say you have $1,000 account. You will place a stop loss that, okay, if this market goes against me, I am willing to lose $10. But if this market goes in my direction, I am willing to make $50. I am willing to make $20, whether I am there or I'm not there. So you can see that sometimes in the market, you don't need to be there watching your screen day and night. You can just do your analysis, click a buy or a sell, place your stop loss, place your take profit, and go and do other things. Allow the market to do what it ought to do. You cannot control the market. No matter how much you decide to sit in your seat, you cannot move the hand of price. So it is better to utilize these parameters to your own good and do other things so that your psychology and emotions will not be tempered with. So it's always very important to do use these parameters. So I will go ahead to do to explain it properly using our chart. So let me share my screen. Okay, I'll still be using our Euro USD illustration. So let's assume I saw this perfect analysis. Yes, the market broke this level. It retested, but it has not really retested perfectly. So let's assume that I'm anticipating that the market will come here. We come at this point. Okay, let me delete and use this very one. let's say that the market will come down here and do something like this. We'll start going up. So this will be assumed to be what? My entry point. And this we assume to be what? My stop loss. Ouch. What let me use good. Okay. All right, this will be what be my take profit and TP. So know it. I said that this very one will be what my stop loss. This will be my what entry point, and this will be what my take profit. So this is a perfect analysis for me. I'm anticipating that market price will come form what a double bottom. So I will enter the market to do what to buy at this very point, to buy at this level. If the price of the market gets to this level, I will buy. Then I will do what place my stop loss around here, maybe for a how many pips is that from here to here? That's for a 33 pips. So that means if the market hits me out here, let's assume I have $1,000, and maybe this from here to here is what 33 pips. I may decide to do what loss $33 if I'm using 0.1 lot size. So if the market goes against me here, I will lose $33. But if the market goes in my favor, starting from where that I entered, I will make $211 in the market. I will make what $211 and I will lose what $33 if the market goes against me. So that is what a perfect way of what carrying out your analysis and entering what the market. So if I enter here, if I enter at this point, I'll place my stop loss here. Then what place my take profit here. So that is what a perfect illustration of what the what sorry about that. So that's what a perfect illustration. All right. Just as I explained earlier, I think we kind of gonna close the curtain here on entry. So I've been able to do what explain our entry point and our stop loss and our take profit properly using the illustration on our trading view. So this is what episode 5. I will actually what continue in episode 6. So I don't want my videos to be what a kind of very lengthy. So we have come to this lesson. I believe you will do what go through it and find it was very useful, please click the subscribe button and watch the notification button so that whenever I upload new videos, you'll be informed. Thank you very much, and have a pleasant day.